Okay, so the first thing that we're going to go over is we're going to go over a brief little overview of the first boot camp, right? And then we're going to jump straight into the second. First off, day one, we covered market structure. That's something that you need to understand, to the T, meaning, you need to understand Wyckoff. You need to understand how the banks move. You need to understand who actually, manages the banks. You need to understand significant candle movement, essentially, how candles actually move and how they, how they can affect your psychology. Bank logic, meaning when are banks in drawdown, when are banks mitigating their losses, when are banks, doing this or that. Wyckoff basics, you should know accumulation, distribution, expansion, and contraction, right? Order blocks, you should know exactly how an order block works. I do not need to explain that to you. Order blocks should be a second nature. Trade management, meaning you should have come up with your schedule by now. You should be, a professional and have a schedule. Okay, your top down, essentially how to go from the weekly to the daily, from the daily to the 4 hour, from the 4 hour to the 15-minute, right? Stuff like that. And what we're going to cover today is another very, very heavy, a little lighter, but very, very heavy plate of food that we have today. And it's going to be a little bit more advanced Wyckoff, and it's going to also be a couple important notes, words, and after that, we're going to be touching on reaccumulation, redistribution, fundamental theories, which are 4 laws, right, as well as a couple others that we have in our mix. We're also going to be talking about how Wyckoff and liquidity mix, right? Essentially, you guys know that one of our laws is liquidity is king. Then how can we apply liquidity to Wyckoff, right? We're also going to be talking about 1-minute entries and what to look for on those entries once we have established, our day one type structure on the higher time frames, right? And we're also going to talk about Asia range theory. Since we're a little bit crunched on time, I don't know if we're going to touch on Asia range theory. I might put that in day 3, and then I'm going to leave you guys with some homework. Okay, that's essentially what we're going to do. So starting off, we're going to go back to the whiteboard. And I know you guys love the whiteboard. So we're going to first off be talking about the advanced traditional Wyckoff. And essentially, what does that mean? You have to know a couple things, right, that go into the actual schematic, right? And first off, as you guys know, right, there is going to be a trading range. Now, my students already know this, but for all of you that don't know this, I will explain it to you shortly. Essentially, this is your trading range, right? This trading range has something very, very important called equilibrium, right? Essentially, it's the 50% of this position, right? And what equilibrium essentially is it's the midline where price will essentially show how it wants to move and how it wants to, and it will basically show its willingness to buy or its willingness to sell at this position. And let's go ahead and draw a price. Let's say we have our PSY, right? Our selling climax. What is our next phase? Can anybody tell me what our next phase is?
Is it the automatic rally or is it
right?
Automatic
test? Rally.
Oh yeah, the rally.
And what is this called?
The
Secondary test.
Secondary test.
Secondary test. And this establishes the what?
The spring.
Trading range.
The trading range. Now what is this?
The spring.
Spring.
Or sign of strength.
Test. Sign of strength. LPSY, right? Perfect. Now, this is essentially a very, very standard Wyckoff schematic, right? We have our preliminary point, right? We have our selling climax. We have our AR. We have our secondary test. We have the established trading range, or STR, that's what I call it. spring, test, and then we have our LPS. Well, you could call it a bounce up, or you could, well, this is the bounce up. Whoops. Make sure you guys mute yourselves as you come in, please. Okay, and then we have our LPSY. Perfect, right? And the LPSY essentially is going to be something that happens later on. Oh, whoops, that's actually in the wrong place. You can consider this one right there, and you can also consider this an LPSY. Or an LPS, my fault. And from here, what we're going to focus on is we're going to focus on this range and the equilibrium. Now, the equilibrium, right, is essentially showing what the range is, right? And it's going to show two very, very important things, which my students already know, but I'm going to show you guys today. The top up here, when you want to sell something, what do you want to sell it at? Do you want to sell it at a higher price, or do you want to sell it at a lower price?
At the discount?
Right. You want to, wait, you want to sell it at the discount?
Sell it at
Or the premium.
You want to sell it at the premium, right? Because if you sell it at the premium, then you're good, right? Because you're selling it at a higher price. So you're going to be selling at the premium. Perfect. And then you're going to be buying prices. You're going to be buying something at what?
A discount.
At a discount. Because if you can buy something at a lower price, then you're going to buy it at a lower price. And then the premium and the discount is going to be something that's very, very important. So I need you guys to memorize these definitions. This up here, right, if you're above equilibrium or the 50%, you don't want to be looking for buys up there. Can it buy from premium? Yeah. Is it more expensive for banks? Yes. You don't want to be buying at premium, okay? You want to be buying at discount, and you want to be looking for willingness to buys during discount, and you should be looking for willingness to sells at premium, right? You should not be looking for, buying at premium and selling at discount, because that's what a lot of people do, and that's known as late retail, right? Meaning people that don't exactly know the ways of the market, they're going to be buying low, right? Well, they're going to be trying to buy low, but while they get their 7 confirmations, they've already caught the bottom. No, sorry, the top, right? And they won't have any other space to buy. So essentially, I want you to memorize these two, okay? And then the middle right here is going to be known, and I'm going to switch the color for this one. It's going to be equilibrium. Now, one of our fundamental theories of the market, which is, I'm going to go straight into that as well, is that the market prefers to stay in equilibrium, right? It tends to respect discount, and it tends to respect premium. The reason for that is fairly simple. It's cheaper, since now we know who actually moves the banks, right? It's cheaper for banks to actually buy positions or put in more positions at what prices? It's easier to, so if we're in accumulation, where are banks looking to buy from? Premium or discount?
Discount.
Discount. Why?
Because it's cheaper for them to buy more.
Right, perfect. Not only that, but you will also find out that when it goes down back into discount, what can they do to their entries over here?
They can move them over for when it's about to sell again.
Perfect. They can mitigate their losses, right?
Yeah, mitigate.
And if they mitigate their losses, their sell entries that were right here, right? Since in this case they're buying, right? If you are buying, let's go back to our day one. If you're buying, there has to be a willingness to what? Sell, right? There has to be a willingness to sell if you are buying. So first off, we know, let's say they come in with 900 million lots right here for a buy. They have to at least have some sells in that market, right? To not completely obliterate the market. So what they need to do is they need to add sells. However, what they also need to do is mitigate their losses so that they can have the maximal profit. So what are they going to do? Boom, they're going to shoot back up. right? And then they're going to come back into discount, and they're going to place the LPS or the the last point of support in discount, because then they can mitigate their losses at the bottom here. Make sure you guys mute yourselves as you guys come in. And then from there, they're going to push back up. However, how do you spot premium and discount? How do you spot willingness to buy or willingness to sell off of premium and discount or a PD array? Essentially, what you want to do is whenever you have a range, you take the bottom and you take the top. It's essentially kind of like using a fib. And I explained how to use a fib in the day 1 bootcamp. And if you don't know how to do that, you will have to go back, because I don't want to take another 15 minutes explaining it. So essentially, you have to have the 50%. And that 50% will essentially show you that the pivots of this range will always be, if they are selling, they will be in premium. And if they are buying, they will be in discount. If the banks decide to turn price around, say right here, right, and buy in premium, you would have been given an entry before in discount, right? So that means that banks are being inefficient, and most likely they will have a deep retrace trying to cover those losses, right? Or maybe even go back to the test and retest that structure. Okay, so that's something very, very important that you guys need to see. Now, this is for accumulation. Does everybody understand premium and discount for accumulation?
Makes sense to me.
Yes,
Right?
sir.
Perfect. So this can even be applied outside of Wyckoff. Premium and discount theories can be applied completely outside of Wyckoff. Essentially, you want to use it every single time that you are trading, right? Anytime that you're trading and you're planning on taking a buy, planning on taking a sell, take a look at the previous range. And then you'll usually know whether or not you should be buying or you should be selling. Now, there are some important things that you need to know, right? First off, you can use your fib to try to get you an area, an estimated area of where price will return to. But keep in mind that fibs are a range finder. So there's different tools that we find, right, in the market. And I'm going to take a break from Wyckoff and explain this to you guys. So there are a couple tools that we use in the market, right, that are that all have different, how can you say it, all have different purposes, right? So for us, let's say we go to GBP USD, right? Actually, let's go to GJ so that I can actually use the next example. And those of you who are on day 1 will recognize this example, but it's a perfect example. So first off, whenever we look at a range, we want to look at the previous highs and the previous lows, right? And we want to see what purges what, right? So if something purges a high or if something purges a low, you're going to immediately tell, right, that structure has broken, and you want to take a note of that. However, that's going to be a little bit later. So first off, there's going to be a couple things, a couple tools that you guys need to be using essentially, right? First off, it's going to be your fib retracement. Now, a lot of people give the fib retracement a little bit of a bad rep, but that's because they use the 61.8 quote unquote golden ratio, whatever. You shouldn't be using this type of stuff because the market doesn't move off a magical number, right? The market essentially moves off of an algorithm, right, that already has typed in or predicted where price is going to move, right? However, the fib is something known as a range finder. To me, this falls within a category of a couple different tools, meaning the fib, right? There's also the PD array, which if you modify your fib, you can just have the 05, right? Or you can even just draw it like this. So you put it at the 1, right? And then you drag it all the way out to the 0. And let's reduce the opacity for that. Perfect. And now you click Alt and H on TradingView, and you just draw it right in the middle. This point right in the middle is going to be your equilibrium, right, to whatever range you're in. And this PD array, right, is going to be something that you can use and is something that also falls into the category of being a range finding tool. And essentially what a range finding tool is it takes your position in the market and it tells you, hey, this is probably where price is going to go to, right? A sniper has a spotter. You have a rangefinder, right? And that rangefinder is essentially going to help you spot or give you an area where you can go down into lower time frames and actually use what I taught you in part 1, right? So now that we've done that, what is my zone for retracement on the fib? And this is one of our market theories actually, so let me go right into that and let me start typing this one out. This one is called market extremes theory. And essentially this states that due to the amount of money in the being placed into the market by the banks, mitigation must occur. However, since banks create pivot points, the banks will usually retrace close to those pivot points, otherwise known as market extremes. Essentially, the market prefers extremes. The market prefers extremes, and you guys can go ahead and write this in your notes. The market prefers extremes because of the amount of money in mitigation that must occur within the market, right? Since there has to be this much mitigation and they have to take out this much money, they prefer to take the market to extremes so that they can, 1, get a better entry, and 2, they can be as deep in discount or in premium as they possibly can be, okay, without completely not having structure at all. Okay, so perfect. Let's go ahead and go back to our rangefinders, right? Which is our fib and our PD array. Okay. Another thing that falls into our range finding category is, can anybody guess what our last thing is here? Can anybody guess what our last range finding tool actually is?
Maybe quarters?
Quarters. Okay, yeah, that's a good one, but a lot of people don't know what that is. You do because you're with me, but that is something actually perfect. All right, quarters. Anybody else? I taught this the first section. Volume is more of a confluence, not a rangefinder, because it can't tell you where price would most likely go toward. Well, the answer is order blocks. Because essentially you can use order blocks as limit points and you can set and forget them if they're properly placed, of course, right? And from there you can kind of just use them and say price is most likely going to hit this extreme, right? And from there we'll go in my direction, right? So those are the ones that I consider my range finding tools. Okay, now that we've gone and discussed this, does everybody have this written down? Does everybody have this positioned? My kill zone for the fib is going to be between the 886 and the 79, and you can even extend it to the 705. So this position right here, in which your equilibrium will be your 79%. Right, to me, this is my kill zone. And if you guys want my fib levels, which contain institutional fib levels as well as my extension fibs, here you guys go. You guys can take them right here. Whoops. There you go. Perfect. Now we can go ahead and get rid of this. And I can show you the next part in this series, which is essentially the words about Wyckoff. Now, you guys have to remember something about Wyckoff. Whenever Wyckoff was developing his system, he realized that the market moves in cycles, right? The market moves in sell cycles and buy cycles, right? And the most important thing about Wyckoff, and for it to work, is you have to understand when structure is broken and when structure is held, right? Essentially, structure for Wyckoff is held as long as the spring is not broken or the shakeout is not broken. If the shakeout is broken, you want to look for something different, right? You want to look for something different. However, there are times where the market does something like this, and I saw something like this morning, right? So it comes up, it forms this, right? Comes up, mitigates, and then it forms this range, it drops, and then it shoots back up like that, distributes again very quickly, and then continues dropping. There's a very, very valid reason for this, and essentially what those reasons are is, one, liquidity runs and liquidity purges, right? Those two essentially go hand in hand, which I will discuss on day 4 more in depth. However, what you have to realize about Wyckoff and what you have to realize about most structure is that structure will continue making these points, and it won't just randomly in midair flip on you, okay? There is no way for structure, due to the algorithm, there is no way for structure to just in the middle of a range just shoot, right? There's no reason for that. There should be a reason for that. Go lower into the time frames because price is fractal. So now that we've actually discussed that, let's actually discuss our 4 fundamental rules, which we're going to be using. And the reason why I'm repeating these is because they're extremely important. So, first rule. What is our first rule?
Price is fractal.
Price is fractal. Price is fractal. What's our second rule?
Liquidity is king.
What's our third?
Time and price correlate.
And what's our last?
Supply and demand rule.
Perfect. Now, whenever you guys think of these rules, these have to be in your mind every second of your trading. And there's a big reason for this. The reason for this is essentially, you have to realize and you have to prove to yourself that these are real. For example, price being fractal. This is something that is very widely known, right? Because time frames work like building blocks, right? So the lower time frames make the bigger ones. Liquidity is king because banks need liquidity, right? Again, this is a weight-based market, right? Meaning that whoever holds the most money moves the market the most, right? So banks need liquidity. And if you as a trader, or banks don't really care about your $100 account, they don't care about your $600 account, but they care about the $100,000 account. They care about the $500,000 account, the $1 million account, which there are way more than you may think there are in the world. They care about those, and a lot of traders trade exactly like retail, even when managing those accounts. So I know you've heard a lot of people say this, but if you can't flip a 100, you can't flip 1,000, or you can't flip 100,000. That's true, because you essentially don't know what you're doing, right? Now that time and price correlate, time and price correlating means that, well, what does that mean? Can somebody give me an explanation on this? That was in part 1. Can anyone give me an explanation?
Based on the volume.
Right, so you want to trade based off of the session, right? And you want to trade based off of the volume that you're going to see within that pair, right? Perfect, awesome. Now, who can tell me what, well, actually, I'll explain it to go a little bit faster because we're a little bit scrunched on time. Supply and demand laws, essentially the willingness to buy and to sell. If essentially, if supply goes up, price goes up, right? If demand goes up, price usually goes down because supply lags, right? So essentially what that's saying is if there is a willingness to buy, there has to also be a willingness to sell, right? Why? Because essentially, right, if we draw an array that shows our supply and shows our demand, right? What are we going to see here? That as price reaches this equilibrium, or the 50% usually on our fib, there has to be a willingness to sell from somebody, meaning that the supplier, right, meaning the supplier of liquidity, there has to be a willingness to sell liquidity to the people that are demanding liquidity, meaning that they want to get into the market. So people have to exit trades. They have to give up liquidity back into the market, or their money back into the market, for other people to take up that liquidity, which essentially are the banks. Now, here's a common misconception which I want to completely eradicate, because I've seen this on Instagrams, I've seen this on social medias, and I want to slap somebody every single time I see this. Just because there is 6.7 whatever trillion dollars of liquidity in the Forex market does not mean you're going to touch it. It simply means that somebody is giving up, or like, you know, multiple entities are giving up 6.7 trillion dollars worth of liquidity in the market. This can be literally from one account to the other account. Okay, so one bank can give liquidity from one of their bank accounts to another one of their bank Forex accounts. Okay, they can bounce liquidity like that and make money. Why? Because who says that these are two different entities? These can be the same bank. They're just giving up liquidity in the market, meaning they are mitigating losses, right, back into our, you know, our spring, our test, and our LPSY, right? All of these, test, spring, LPSY. What happens? Willingness to sell at this position, meaning that market reached equilibrium at this position, right? Since the market reached supply and demand equilibrium, there is now a willingness to sell liquidity to the demander, which essentially at this point, the demander is the same bank trying to put more buy positions into the market right here. But what are they selling? They are closing out all of their sell positions and moving them over to the buy position. Okay, does that make sense?
Yes.
Some people will say this is useless to learn, but you need to know the why. If you don't know the why, you're going to be lost on many things, okay? You need to know this, all right? Now, there is one more, you could say, rule that is, well, actually, it goes a little bit under liquidity is king, but essentially, if there is exposed liquidity anywhere, price will most likely, will always return and collect liquidity. So if there is open liquidity, be wary of those positions, but also be alert that that may be a possible trade idea. Let me show you what I mean. So on EU, there was a solid position which I took earlier this week. Right, there was this position right here. However, actually, let's look at it on the 2-hour. However, there was this exposed liquidity right here. Because of this exposed liquidity right here, it kind of deterred me from continuing in sells. And look what ended up happening. Previous structure pushed it back up, collected as much liquidity as it could, right? It returned to its extreme, and then from there fell. Let's look at our range finding tools. If we look at our fib, it was right within our institutional sponsorship levels. Perfect. It doesn't always need to be there, but that's just, again, it's where you look down your scope. So around this position is where you would be looking and you'd be saying, where can I see distribution? Right? Where can I see distribution? Perfect. Next, what ends up happening? Let's pull out our second range finding tool. What is our PD array looking like? Our PD array looks something like, what's our previous low? You could do two previous lows, right? You can do two PD arrays. You can do one that's more immediate, right here, right, and put equilibrium right around this position. That would have been perfectly valid. Or you could have put your PD array starting right here and dragged it all the way across up here and putting equilibrium below, which is completely fine as well. I would have put it right up here simply because it was the most recent low, right? It had to be the most recent low for me. So that's what I would have looked for. But essentially it's up to the eye of the beholder, right? But our PD array again shows, right, there are 2 points of equilibrium, which above these points of equilibrium is what? It's premium. And below it is discount. Now, what's our range say? Our range essentially says that if we cross below this, we're looking at a completely different range, right? And if we crossed above this, we would start another range as well. However, we didn't break out of either. We did break out of this minor range though, where our equilibrium was right here. Now, if you see where all of the pivot points in the market were, where were all the pivot points in the market? They were in their respective positions, right? For every buy, it was at discount, and for every sell, it was at premium, right? For every sell was at premium, every major sell was at premium, and every major buy was at discount, right? Every major buy was at discount. Now, just because it hits discount or premium, right, whichever one of the two, does not mean it has to sell immediately. Okay, that is a note you need to take, that you need to, keep into consideration. Just because it's either in premium or discount does not mean that it's going to sell off immediately. It essentially means that it has more willingness to buy or more willingness to sell, or you may see a lot of what's it called? A lot of retraces. But at the end of the day, you are going to see one is going to outweigh the other, right? Or else you're just stuck at equilibrium. If premium and discount are the same thing, it's stuck at equilibrium and your market would look like this. It's going to be a straight line. Nothing's going to move because nobody has a complete willingness to buy and nobody has a complete willingness to sell, or they're equal and it doesn't move at all. Okay? So one of them has to overpower the other. And if we look at it from the 2-hour perspective, what do we see? What has more willingness? What is beating the other? Who is winning?
Discount.
Well, in this case, premium is winning.
Premium.
Premium. Why? Because it's in distribution, right? Since it's in distribution, especially on the 2-hour time frame, you can expect a very, very major sell off of this position, right? Now, let's say we added our PD array to this point. Let's say we used a range finding tool. Where's our equilibrium? Right up here.
James, is PD array just the fibs?
No, the PD array. So the PD array is essentially this. The PD array is going to be the premium discount array, right? And below this position, so let me actually mark the low and mark the high. So I'm marking the low right here. This is the low, and let me mark the high. Marking the high right there. Perfect, right? Now what's going to happen is from here to here, this right here is our premium. Okay, so let's say we sell off of that position, right? And then down here, from here to equilibrium, is going to be our discount. Now the reason why it's called an array is very simple. It's simply because that is the array or the areas that you can expect price to either buy or sell respectively. Meaning, that it has more of a willingness to buy at discount, and it has more of a willingness to sell at premium, correct? Look at where all the major pivots took place. So up here is premium, and down here is discount. Look at where all these pivots took place. Look at that. It sold off from here, sold off from here, sold off from here, sold off from here, sold off barely tapping equilibrium, sold off right there, sold off and established a new range, right? So it purged the high up here, but where did it start buying from? There's no reason why you should have been caught off guard by this upthrust, right? Why is there no reason for you to have been caught from caught off guard by this upthrust? Let's back test. At this position, you have a 4-hour PD array, right? The PD array essentially just establishes your premium and your discount on higher time frame. That's all that a PD array is, okay? This right here, who can tell me what this candle is?
Inefficiency?
No, not quite. Not an inefficiency.
Liquidity?
Right, exactly. Exposed liquidity, right? And that exposed liquidity is going to have to be filled, right? That's one of our subheadings of liquidity is king, right? Since liquidity is king, and this is exposed liquidity, what does price have to do?
It's gonna follow it up.
Right, it's going to follow it up. So there is what? Bullish volume that runs into a bullish position. And I will go over volume profiles in day 4. So let's say we go to the 3-minute. What do we see? We see this giant point. We see this little piece of accumulation right here, and we see this mitigation taking place, right? This mitigation of our previous positions. Now, if we see what ends up happening, we're going to see that price ends up firing off out of discount, right? Why? Who can tell me why price fired off from discount? What is there more of a willingness of?
To buy.
Right, there's more of a willingness to buy, which means that in this case, right, supply is outweighing demand. As supply rises, price rises. And you see how this right here, which was previous liquidity, was captured. So now, one of the most important things that you have to take in mind about minor time frame Wyckoff is you have to end up seeing when highs and lows get purged, okay? And then from there, you want to take your position. You usually don't want to take your position unless a high or a low has been purged, okay? So even if this right here starts stepping up, you don't want to get into this position, even though as tempting as it may be. And, you know, in hindsight, you see that it turned out well, but you usually don't want to get into a position until you have at least verified that your position is going to be somewhat stable, which means that you want to see your sign of strength or sign of weakness before actually entering into your position. So in this case, let's see what ended up happening. Every buy ended up happening below equilibrium, right? Which was right here. Every buy happened beneath equilibrium. Now, what happened when price touched equilibrium? Here's an addendum to the equilibrium rule. And the addendum to the equilibrium rule is going to be, you can touch equilibrium and bounce off of it. Okay, you can. Does that mean it will? No. But that's exactly why you want to see previous structure. Right here, you see a structure called a breaker. And a breaker essentially is characterized by this right here. So essentially, it's a move that goes up, right? Then it comes back down, and then it shoots up without any, you know, any kind of repercussion. Essentially, price will usually return to this range. And you can see these on higher time frames as well. I will go more into depth about breakers, rally-based rallies, drop-based drops in the future. However, usually that's what price ends up doing. Sometimes it does end up doing this though, because what was our last law, our fifth law that we introduced today? The market what theory?
Market extremes theory.
Market extremes, right? And market extremes essentially states that you can go as far as back here, right? You can. It is more than within the bank's rights to do that, right? However, what is not within the bank's rights to do, unless they want to, you know, completely go in the wrong direction, is break structure. You will never see the banks do this. They can't. They shouldn't, right? Because that's very, very inefficient for them. Because now the majority of their positions are in drawdown. Think about it, right? If they entered off of a breaker, right, and they want to mitigate their losses as much as they can, they're going to come as close as they possibly can to break even, right, for their sell positions in this case. But why would they put 900 million lots into drawdown? For no reason. They wouldn't. They don't. Why don't they? Because it's not efficient. Not when you're dealing with that amount of money, right? So what are you going to do? You're going to respect structure and you're going to continue up. Now, once structure is broken, that's a completely different deal. Because once structure is broken, then you essentially, the banks, it's their play day, right? They can do whatever they want with liquidity. However, they will always show a sign of reversal, or they will always show a positional sign where you can get back into the market. Now, the high has been purged here, right? The previous range was purged. So what happens, you establish your new PD array, which now includes a new swing high and a new swing low, or the most previous swing low. Boom. Now what ends up happening, let's establish our PD array. Boom, where's our equilibrium? Right here. So where did the buy actually end up happening from? In discount. And it ended up happening within discount. So right here, once you saw this accumulation, or sorry, yeah, this little accumulation right here, and you saw in previous structure this breaker, you could have said, hey, we may have a good entry here. So what are you going to do? You can essentially place your long position as close as you really want. This is in hindsight, right? But where is your stop loss going to be? Essentially below structure. That's a larger stop loss than I'm used to. But again, this wasn't a very clean entry for you. You're trying to clean this liquidity up here. And because you have your law of liquidity is king, you know for a fact that price is going to clear that liquidity, right? That price is going to clear that liquidity. However, let's keep, well, actually, as we keep watching, you'll end up seeing that price actually did end up taking out that liquidity and getting extremely close to your take profit because of the fact that you respected, right? And I'm not saying that you would have caught that position, but I am saying that you understand now why that position was taken, because of the fact that, you know, every single pivot was taken in discount and every single sell was taken in premium. And ones that are like, let's say it starts selling in discount and it continues selling in discount. What does the market tell us when it starts selling in discount? What does the market tell us?
It's the change in trend.
Change in trend. It tells us that demand now overpowers supply, right? Demand now overpowers supply because of the fact that price is now shifting, right? Price is now shifting. So here is when we go into our next point. Now that you understand supply and demand, now that you understand why banks move as they do, and now that you understand PD arrays, let's go into reaccumulation and redistribution. Who can tell me what these are? And I think we're going to start with reaccumulation first. Who can tell me what these are? If anybody knows. If not, it's fine.
It does it again after it just did it.
Right. So essentially what you want to see is you want to see price continue up, right, after it's already accumulated. So a lot of times, do you guys remember the two phases of the market?
USD, two possible.
Gonna contract or expand.
Right, so contraction and expansion, right? Contraction and then expansion. But within said expansion, price can't just go in a straight line. What does it need to do? Price can't go in a straight line. It needs to kind of rest for a little bit and then continue up. Right? Which is essentially...
You went over the term, but I forgot the name of it.
Reaccumulation. It has to reaccumulate, right? So I'm going to give you guys a bit of an example of how this looks like. And let me go with a nice on the eyes color. So let's say price has already started moving up. Right? Price has already started moving up. And let me actually, that was horrible. Say price has already started moving up, right? It creates our PSY. It creates our AR. Well, our buying climax. It creates the AR. And then after that, usually a lot of the times in this, shakeouts don't occur. Sometimes they do. A lot of times they don't. From my experience, usually it doesn't. And we're going to go off of these. It's a little bit lopsided, but I can't be bothered to draw better. So let's go ahead and go over these terms, right? So right here, we have our PSY, or our PS, right? Or yeah, our PSY, right? We have our buying climax. You could consider this a shakeout, but I'd make the established training range. Or you can even consider this a secondary test as well. AR. And then here is something that you're going to need to know, okay? There are two different terms for this, and it's called a creek, okay? This creek, essentially, it's going to be shown throughout Wyckoff, right? A lot of times, the word creek is replaced by, it's replaced by equilibrium. But essentially what a creek is essentially this little position right here, right? And this little channel down here is going to show you the willingness to buy, right? Because once you jump it, you're going to expect a shakeout and then a move up, okay? So this right here is called the creek. And then from there we get our spring. Springs sometimes don't happen, which is completely normal. But if a spring doesn't end up happening, what can you infer? What is the creek telling you? There's a willingness to what?
So
There's a willingness to sell. There's a willingness to buy, right? Because you just jumped across this range. Since that range was essentially now jumped across, this is now mitigated. This is essentially what reaccumulation is going to look like. You realize how it looks a lot like distribution?
Yeah.
It looks a lot like distribution, but there's a couple fundamental changes. Essentially, there is a failure to stay above equilibrium, which equilibrium would be like right around here, right? There's a failure to stay above equilibrium. Usually, when a trade decides to buy or sell, it will spend the majority of its lifetime in the schematic in either or, showing its willingness to stay beneath or below. Okay, and this is why PD arrays are so powerful. Okay, because essentially they find you not getting stopped out, right? So again, we have our premium up here and our discount right here. Perfect. Now, ask yourself, where did price spend the majority of its time at?
Discount.
Spends it in discount, which means that there is a failure to stay above equilibrium and stay in premium. Meaning that if we had our volume indicator down here, we would see no bullish, we would see no bearish volume. There would be no bearish volume. There will only be a willingness to buy, meaning volume would spike when this happens. 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 I'm setting you up for volume profiles, but I want you guys to understand how premium and discount go into Wyckoff as well. Because not only did price fail to stay below equilibrium, right? Sorry, it failed to stay above equilibrium, meaning that it had now a willingness to sell. Instead, it stayed beneath and it stayed in discount, showing that it now had a willingness to buy. Since it now has a willingness to buy, and it spends most of its positions within discount, you really only want to be looking for buys in this position, because you really don't even come back to test your AR until way later, right? Now, would you have realized that this is an AR at that point? No. But once you see this creek and you see it get jumped up and then start dropping again, you should realize that this spring right here would be reaccumulation. Now, a lot of people will tell you that you may never see reaccumulation, or you may never see redistribution. I disagree. On lower time frames, you usually see it a lot, and you have to distinguish the difference between one and the other. A lot of times, the difference between distribution and reaccumulation doesn't show its face until the very end, which essentially ends up being the spring. It ends up being the creek. It ends up being the failure to stay above equilibrium, right? So essentially what you want to be looking out for, and these, you can even use your 1 minute time range, right? Your 3 minute time range, and you could be placing your PD arrays and seeing as, you know, price breaks the highs, breaks the lows, stuff like that. You can be adjusting your range and saying, okay, well, positions are now being opened, right, above price. Is price staying above equilibrium? Is price preferring to stay beneath equilibrium? And depending on those answers, you can tell the difference between reaccumulation and actual distribution. Okay. The price will not always look like this. Okay. A lot of times it will look like the PSY will be right up here, right? A lot of people know the pattern triple top or whatever it's called, right? Or double bottom. A lot of these positions end up getting destroyed because they're just parts of the range. Now, next is going to be redistribution, and I'm actually going to show you guys a live example of this. Is this making sense to you guys? Are you guys understanding this?
Yes.
Yes.
Where is this? Oh, it's right here. Okay. Looking on the weekly. Let's go on the daily. So a lot of you guys have seen this example before because I've used and abused this example. But what is this? What is this right here?
Is that a accumulation?
Remember that accumulation means buy and distribution means sell.
It's distribution.
Right, it's distribution. However, it is a special kind. which is called redistribution. Now, why is it called redistribution in this case? Well, because look where it already distributed. You see where it already distributed? Up here. Since it already distributed up there, this right here is called redistribution. Why? Because you're distributing essentially in a downward position. You're distributing in a downtrend. Okay, and it's going to be the exact same points, right? Except there are a couple different variations. So who can hazard a guess as to what reaccumulation will usually look like? Who can tell me? Like who can at least guess? And if you can't guess, that's completely fine. We'll actually go back to the whiteboard and actually draw it up for you guys. A lot of times redistribution will look like a channel, right? A lot of times reaccumulation will look like a channel. So a lot of times you'll see reaccumulation right after a position like this, right? This right here was reaccumulation. Now you'll also see redistribution in a similar position, and let me explain to you why. So essentially, let's say price is dropping, right? And now price establishes what is known as a channel. Now, channels are real. Don't get it wrong. Just because I say trend lines are myths, don't get it twisted and say that channels aren't. Channels very much are real. Okay. Now, our channel essentially is drawn. Whoops, that is horrible. Essentially, I have not a line for channels. I have a zone for channels, right? So let's say, boom, that's our channel. And whoops, boom, this is our channel. Now, what do you guys think is going to go in the middle? And let's see who can read my mind. What's going to go in the middle of this? In the middle of this channel?
Equilibrium.
Equilibrium, perfect. Equilibrium is going to go in the middle of this channel. Why do you think? Oh, that's actually pretty bad. That's not a straight line at all. Why do you think equilibrium is going to go in the middle here? Because everything has equilibrium. Everything has equilibrium, even channels, right? Now, the most important thing to know about this is that you have to continue a downward structure. In very basic terms, what is a downward structure? Essentially, you have a lower high and a lower low, right? It's as simple as that, really. Because price can do whatever in the middle as long as it makes a lower low or a lower high, right? So in this position, let's say, let's use a different color. Right here, you see this low being purged. You see this low being purged. You see this low being purged. And you see this low actually being respected. Why? Because it actually came back up and retested. Now, what do you think this phase is called? What do you think this little position is called? Can be our UT, right? And then from there, we will have our test. And then from there, we will have our LPSY. Right? Now, what is this right here? What is that right there?
Is it sign of weakness?
Right. Perfect. It's our sign of weakness. It's our sign of weakness. Now, this sign of weakness ends up going back up where? Into what?
The premium?
It goes back up into premium, which shows that it now has a willingness to sell. Now, if we go back and we look at this position, how can we tell this is indeed redistribution. Look at how much volume, or look at how much time it spent above rather than below. The majority of the big moves stayed above equilibrium, which means that it has more of a willingness to sell because it constantly stays in discount. Oh, sorry, in premium. It constantly stays in premium, right? And once the channel is tested and the upthrust is tested, the LPSY goes one last back time into premium to sell off completely, right? There are two possible positions that you can get into this. Here's also the difference between accumulation, right? And you're going to see this a lot on lower time frames, accumulation and redistribution. Look what happened to structure here. And this is just off an eyeball. Look at this. If this was reaccumulation or accumulation, what should have happened here?
It would have been above that line.
It would have been above or equal to. It was not above or equal to. It was below. And even if structure decided to come back up, then our test was our first entry because this would have given it away. So this could have been our first entry. Now, what range finding tool would have given us this position up here, apart from equilibrium or a PD array? There are two.
Order block.
Order block and
Fib.
or fib. Perfect. So what gave this away that this was redistribution instead of accumulation? Because they look fairly similar from here to here. What gave it away? The break of structure. Right? This can be considered a miniature sign of weakness. Right? Now this up here was considered the upthrust, and then up here was considered the test. So using our range finding tools, we could have realized that based off of this range, based off this channel equilibrium essentially says, hey, our channel is now above in premium and it has more of a willingness to sell. It showed us a miniature sign of weakness, which broke any accumulation structure that was possible at that point. Which means that once it retraces to this position, we can have a minimal drawdown entry using our fib range finding tool, right? And which we could have dropped to lower time frames and looked for a clean distribution on lower time frames, which would have given us a 3, 4, 5 pip, maybe 9 pip stop loss. Now, the first couple of sessions that I did of this with my students, it's very similar, like it's very, kind of obvious that you can get low drawdown entries, meaning, 3 pip, 4 pip, 5 pip. Don't make that your standard. Well, actually do make that your standard, but also be open-minded and realize that not every setup will be perfect, right? Not every setup will be perfect. Some setups will have larger stop losses. Some setups will have, these stop losses that are considered normal, 25 pips, which is, like the max I'll go. But once you have those stop losses, in this case, this may have been on the weekly. This may have been on the daily. And your stop loss, there's really very low chance that you could have caught that with, a 3, 4, 5 pip stop loss. You would have had to open your mind up and say, okay, bearish structure hasn't broken. It's broken all bullish structure based on this sign of weakness, but this upthrust keeps us in the game for redistribution, right? This sign of weakness keeps us in the game for redistribution. So does everybody understand the differences in structure and how you can identify redistribution and differentiate that from accumulation?
Yes, sir.
Okay. Now, the most important thing about Wyckoff that you guys are going to need to master is going to be essentially your structure. And there's going to be a couple things that you guys need to learn, okay? On the 1 minute, price is not so nice as to give us perfect distribution or perfect accumulation. That's why the seconds time frames exist, but unfortunately you have to pay like $40 a month for that, so I don't want to do that. But anyway, what you can end up doing is something like this. Let's say structure comes up like this, and you'll see it a lot, right? And then it starts rounding, and then it does this. This right here is known as an inefficiency, but it also broke, whoops, let me change color for that. It actually broke 1, 2 lows, which means that this is the what phase?
Contraction.
It's
or-
our sign of weakness, right? And that sign of weakness will have to retrace on itself because of our market extremes theory. Banks will try to mitigate themselves as much as possible through the algorithm. So what are they going to do? Boom. And where's our entry? What range finding tool can we use here?
Fib.
And
PD array.
you could, but not quite.
The order block set before the oh, what's it called? Oh my god.
Perfect. Right here, you would have found an order block, which you could have set your stop loss above this, and your entry could have been within this position. Now, where's your take profit going to be? What tool is going to help you with your take profits?
The lowest lows.
The fib.
The fib. That's going to take you all the way down. Why? Because at that point, you've broken these lows. And now you can easily say, boom, all right, cool, right? Now you're going to hold this position. Now, what would have happened if instead of this going into, instead of breaking these lows and making this sign of weakness, what if instead it would have actually broken through this high, then dropped? Would you have considered that still distribution?
No.
Not particularly, not at that point. It's not a safe entry. And you'd rather catch a low drawdown entry than an unsure entry. Okay, so let it go. At that point, I mean, it's fine. I don't know why price would have done that. It usually doesn't do that. But at the end of the day, sometimes things happen in price that are beyond our control. And at that point, you could just say, all right, that's fine. Let me wait for a cleaner schematic. And a lot of times it will give you a cleaner schematic a little bit higher. That's just kind of showing how higher time frame structure is a lot more powerful than lower time frame structure. And a lot of my students, some of my previous students, actually prefer using higher time frame structure, and that is completely fine. If you're a trader that you see lower time frame Wyckoff and you're just like, I just can't get this, that is fine. There are multiple things, there are multiple teachings that I will show you later on in this series that will show you how to get higher time frame entries and with as little drawdown as possible. Or if say you're working, right, and you just kind of want to get a general area, get a buy or a sell, and you're fine with drawdown because you have a significantly larger account, then that's fine. You're going to be using the daily, the 4 hour more. That's completely fine. You only need 1, 2 trades, 1, 2, 3 trades a week, and you'll be fine. Why? Because you're going to go off of larger time frame structure. Now, you guys see how this structure holds up on distribution, right? So essentially what would have ended up happening is you end up seeing this right here, low drawdown, boom, 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 right? And then we continue downward. Perfect. Now that is your distribution type. Now, what if we wanted to go into accumulation type? What do you hold at this position? You have to hold this high. Sorry, this low, right? You have to hold this low. Now, what ends up happening if price ends up doing something like this? What do you expect at that point? What is this phase? Sign of weakness. This phase being the sign of weakness, now what you want to do is you want to end up counting, right, your low, your low, your low, but it also broke the previous high. And since it broke this high, oh, sorry, not sign of weakness, actually, I butchered that. Sign of strength, so it would be SOS. right? And from here, using our market extremes theory and our order blocks and a range finding tool, we could possibly say, hey, price will most likely end up doing this. And then the beauty about these positions is that you don't necessarily need to take this position if you don't want to. If you don't want to, that's completely fine. Say you're unsure, or you just can't distinguish the schematic yet, and you want to give it another couple seconds. That's fine. Let it bounce off. It will come back to this point, somewhere around this area. Why? It has to. Price buys at discount, not at premium. So it's not going to just sit there, buy a little bit, sell a little bit, and then shoot. It's not going to do that. Go back test it on lower time frames. Sells and buys obviously occur in their respective phases, meaning discount or premium. So price has to respect discount and come back to buy at discount, which means that you will get multiple entries on this. Okay? You will get multiple entries on this. You do not necessarily need to start, you don't need to start panicking if you miss the 2-pip stop loss entry. You're fine with a 9, you're fine with a 10, you're fine with a 15-pip stop. Just leverage properly. At the end of the day, you're practicing, and it didn't take me my first 3-4 days, my first week of training to hit 3, 4 or 5 pip stop losses. It took me like a year and a half. Am I saying that that's gonna happen to you? No. You have guidance. But imagine somebody that was trying to take on the market by themselves. That's why this tool and this organization that you're in is so powerful, because you have access to teachers that know what they're talking about if you look hard enough, right? So let's say, going back to the schematic, most times price will come back, right? And it will fill this range, and it'll come back up, and it will come back down here. Why? Your PD array. Now your new high is up here. So where's price gonna come back to? It's most probably gonna come back up to here, and if it breaks its high, boom, you have a new high. But at the end of the day, you are holding these lows because you have to. For this to be accumulation, it has to hold this position. Now, again, the difference between accumulation and redistribution. This could have been a channel, right? And your channel could have been going down this way, like, whoops, not like that. Like this, right? And now what have you said? Well, you could have said, hey, this was the up thrust. Now let me come back down. However, it failed to what? It failed to show you a sign of what?
Weakness.
It failed to show you a sign of weakness. And once it broke this high, what could have you said? You said, oh shit, okay, it's not redistribution, it's actually accumulation. You don't have to freak out. Why? Because at the end of the day, your entry would have been right around this area, right, which would have been in discount. And then your stop loss could have been behind structure, right back here. And then your take profit using a range finding tool or the fib would have been, the 0, 27, the 41.4, negative 61.8, and all the way up in heaven, right? And that's how you end up catching pips. At the end of the day, you have to realize that you have to be using as many confluences as you possibly can without breaking structure, okay? Because without you knowing market structure, you are screwed, okay? If you don't know what market structure is, I suggest you study that, and I don't mean going on YouTube. I mean going to either, my YouTube channel or Outcome Reach's YouTube channel or anything like that will actually help you with these things, okay? Getting the help that you need. Ask me questions. Okay, if Cam is your mentor or EP is your mentor, they're the guys that put me on the business. Thank them and then ask me for help. Okay, if you're with TJ or Giselle, ask me for help as well. You're on my team. Okay, now if you're a non-member and you want to learn more about this, just DM me afterward. Now going back on topic, what are a couple topics that we actually left out? Let me go back on this. Reaccumulation, blah, blah, blah. How does liquidity and Wyckoff actually mix? Might have to leave that off for part 2. But how do you guys think that liquidity and Wyckoff actually mix? And this was a perfect example of it. How does liquidity and Wyckoff actually mix? Well, very, very easily. You are now, essentially a PD array is a very good tool to spot liquidity. Why? Because that PD array is showing you where liquidity is located at, or the general area of where price will be located. Now, one thing that you can use is exposed liquidity. Exposed liquidity essentially tells you, hey, this liquidity right here is not ready, right? It needs to be taken. Price needs to go in this direction. Why? Because volume spiked as this wick was left, which means that price wants to go in that direction. If volume spikes as this wick rises, that usually means that price wants to go in that direction. Okay, so now what ends up happening? What ends up happening is you end up catching all of this because of a simple position in which you catch this liquidity, this exposed liquidity, right? Because it needs to be caught, it needs to be mitigated. That's a mistake by the bank. And that mistake by the bank would have cost them quite a bit, right? But it also was mitigated in the future because all of their entries that they got from this position, they would probably, they probably took profit from most of their buy positions because they realized that price surge was inefficient. Now, what happened? It came back down, right? Collected more liquidity and then shot right back up. Why do you guys think this actually collected liquidity? Where do you guys think liquidity was located?
That last low.
This low, right? It was located at this low. And you can usually use any trading view little symbol to locate liquidity. I just use the smiley face because it makes me happy. But you can use whatever you want, right? This move happened so quickly that a lot of people had buy stops above this range. And let me actually switch the color of this so you guys can see it a little bit more clearly. Where is the neon green? There we go. I'm going to add neon green. Perfect. So now this liquidity up here was taken out. Why was this liquidity up here even a thing? Well, a lot of times in Wyckoff, you're going to find places where liquidity can be found. Essentially, those are miniature ranges within the schematic. Okay, so ranges within the schematic are definitely a thing. However, you have to learn to find them. Right here, since this move happened so fast, a lot of buy stops were triggered. What was their take profit? All the way up here. Did it eventually reach that take profit? Oh, yes. But keep in mind that this candle lasted 2 hours and this move probably lasted about 10 minutes. Okay, this surge was so powerful that it came up, triggered these buy stops, and then fell back down. If liquidity was down here, what do you think people placed at this position? What do you think people placed right here?
Stop losses?
Stop losses for buys.
Sell stops.
Sell stops. Perfect. Sell stops. Right, and these sell stops got triggered, and then what? In the next hour, their stop losses got hit. Right, in the next hour, their stop losses got hit. Why? Because of this manipulation. Now let's check what time that was. That was at 9 o'clock p.m. Was that 9 p.m.? Yeah, that was at 9 p.m. Oh, no, it wasn't. That was military time. That was during New York. That was during New York session. Why? And New York-London crossover. So now let's refer back to our third rule. Price and time correlate. Since price and time correlate, what do you guys think ended up happening in this position? The euro has a lot of volatility during London, but so does the dollar, which means that a lot of volatility can be expected during this range. So price and time definitely did correlate between this pair and its outcome. Now, there is an indicator that I want to end up sharing with you guys, and for all of you 23 faithful people, I appreciate all of you. I know we started with about like 45 and then half of them left, but I appreciate you guys for being here. And this is going to be the Patty trading sessions. And this has helped me a lot within my trading because it actually helps me distinguish between trading sessions without having to look, you know, at the bottom here. It's called Patty Trading Sessions. And if you guys have TradingView, you can really just add the indicators tab and then look for Patty Trading Sessions. It shouldn't have a lock beside it. It should be free. And essentially what you want to end up doing is you look at this, right? And then you end up clicking your Asia high, your Asia low, and then you can usually turn off London and just keep New York. And then from there, just keep your Asia hours from 1700 hours to 0 hours, right? And then your London from 3 to 8, but you don't need that. And then your New York from 8 to 1700 hours. Okay, so if we activate this and we actually open it, we end up seeing that our Asia range, where was our Asian range? Our Asian range was right here, right? We had our previous Asia range, which was our previous high, right, and our previous low. Essentially what the Asia range theory states is that a lot of times when price consolidates, and I'll get one of my friends' PDFs for you guys. He's actually one of the best traders that I've ever seen. I love him to death. But he when me and him were discussing this, because we had realized this, and me and him were talking about it. And what we essentially discovered is that price ends up breaking Asia range, usually during consolidation. And I'll explain to you what we meant. Let's look and let's see. So this red line right here was our Asia low, and this up here was our Asia high. So let's look at our Asia high, and let's look at our Asia low. What ends up happening immediately? Our Asia low gets purged during London, right? Our Asia low gets purged. A lot of people make their strategies around buy stops and sell stops. But look at our previous Asia range. Price will most times break at least the high or the low of Asia. So depending on lower time frame price action, you should use these as targets, okay? And I'll go more into detail in day 3 about this, and I'll actually get him to get you guys the PDF so you guys can read it. But at the same time, you guys need to start realizing that ranges and liquidity do exist. So people unfortunately do trade this way. They literally just put a buy stop, they put a sell stop, they put a buy stop and a sell stop, right? To try to essentially compensate for the amount of time that they put into the market. Perfect example right here of an Asia range break, because usually what ends up happening is the low gets broken and then it retraces violently, breaks the high, and then continues on where it normally wanted to go. Right? In this case, it broke the low, it came back up, violated the high, which means that it triggered sell stops, right? Hit their stop loss, triggered buy stops, hit their stop loss. So now both of them got screwed over. Now, do you guys see how this Asia range acted right here? You guys see how this high was up there and how this low was down here? You guys see that? Now, once you see that, look what ends up happening. Sell stops get triggered. They're massively in profit. Oh yeah, woohoo! I just flipped my account, and then bam, right? Or what maybe even happened is I can't see what actually happened in this candle, but I think it actually opened. It opened right here, right? So what may have happened is maybe it shot completely upward, hit the sell stop losses, right? Came up, broke this high, which means that it triggered the buy stop, and then it retraced so heavily that it hit their stop losses. Now, maybe sell stops got placed here again. Perfect. More liquidity, right? What ended up happening? It ended up shooting back up and containing this exposed liquidity. I will be going more in depth on Asia range, but that will be saved for next session. I think this has been enough for you guys. And I think that a lot of you guys need a little bit of time to go back test and digest your positions. Does everybody agree, or yeah, I think we can go ahead and end it there, and I'll move advanced liquidity and Asia range. Well, finalizing Asia range to to day 3 or possibly day 4 once we understand mitigation and all that kind of stuff. What do you guys think?
I agree.
Sounds good.
All right, guys. Cool. So first off, let's go over what we went over today. Okay. We went over what makes structure so important for Wyckoff, right? We ended up going over the importance of why Wyckoff works and how it works and the caveats of how it actually works, right? So remember that structure is king. Your structure is going to be ruler above everything. However, remember that in the first session, we said if structure holds, you hold. So as long as structure actually ends up holding, you can end up holding. If it doesn't hold, let it go. With this type of strategy, you shouldn't have a massive stop loss. You should have a very small one, which means that if your stop loss is hit, is that really big of a deal?
No, because you're not losing a lot.
No, because you're not losing a lot. Right? For example, this is an example that I was actually on a live stream with TJ the other day. And we saw somebody, we were looking at a couple people trading, and they ended up going on a buy for SPX 500. Now, when they ended up going on this buy, for me personally, and look at actually where it went. That was actually beautiful. Look at where it went. They had a stop loss that, like, I think on US 30 would have been about $300. To me, that's a little bit much. To me, right? To me, that's a little bit much. However, for them, apparently it was fine, which I respect that. You know, if it works for you, whatever. But for me, I said, well, if stop loss gets hit here and structure break, actually, my stop loss is too small. Should have been up here. But if this stop loss would have been hit on the 3-minute, what do you think this really equivalates to? Or equates to? It's 3.7 points. 3.7 points is nothing. Right? 3.7 points is, see, at a 0.01, that's like $2.30. Maybe $1.30. I don't know what it is, but it's very small. Except their stop loss was supposedly at a previous point of buying power, which was somewhere around here. And that cost a lot because of the fact, like, let's go ahead and look at it on the hour. For me, I prefer looking at indices on the hour because of the fact that indices on the hour show their structure a lot better. If you guys see this, what does this look like?
Distribution.
Does it really look like distribution to you?
Yeah.
Where's the upthrust? This looks more like accumulation, right? There's no upthrust.
Yeah, for a buy, you're right.
Right? Now, some people could argue and say, well, maybe is this redistribution? Well, let's take a look. Is this redistribution? What's our range? The equilibrium of the range would be somewhere up here, right? But essentially what you're saying is this is not redistribution. Why is this not redistribution? Because we've held this bullish structure. Since we've held this bullish structure, the next obvious reaction would be looking at how it reacts around this zone right here. And if it reacts firmly off of this zone right here, then we may be in for a buy. Right? If it reacts firmly around this zone right around here. Why would we be in for a buy at this point? Let's say we theorize that this is accumulation. And this was our spring, and this was our test. Right? And now we're coming in for possibly another test, or we could be coming in for a last point of supply. Essentially using our rangefinder, using our fib, and using our order block, we would end up saying, hey, price needs to come back into discount, which let's put our discount line here, which you could either use the most recent high or you can use your absolute high, whichever one is fine. It doesn't really matter. But just now we're crossing into discount territory. And since we're just now crossing into discount territory and judging on where the previous sign of structure was, where is our position most likely going to be labeled in? Somewhere around this position right here. Somewhere around here, or maybe at this order block. Why? Because there's nothing here. It's a void, it's empty. So it obviously has to fill right here and come back to our extreme to either cement bullish structure and solidify this as an accumulation schematic, or it either breaks this structure and says, no, I don't want to be accumulation, which is completely fine, because then you identify it as a redistribution schematic. Either way, your stop loss is so small because it's behind structure that you don't lose $300. You lose a very, very minimal amount if structure ever gives you confirmation of accumulation. Meaning that once you reach the zone, what time frames do you need to be looking at? Lower time frames. And since you need to be looking at lower time frames, then perfect, right? But if lower time frame never gives you an entry, are you going to get in?
No.
No, which means that our first law holds strong, which is?
Time is fractal.
Price is fractal, right? Perfect, yeah.
Or price is fractal, yeah.
I wish. Well, actually, time is fractal too, because seconds make up minutes, minutes make up hours, hours make up days. So yeah, time is fractal, yeah. But in this case, we're talking about price, right? So we're below equilibrium. And this is where we want to spend the rest of our time here, right? We want to spend the rest of our time in this position. Now let's pretend that we are trying to see this channel. Is there a channel to really equate to redistribution? Not really.
No.
There isn't really a channel to equate redistribution. So in my opinion, there is no redistribution here. Could there be? Possibly later on, but not right now. Right? So if we hold this position, let's see where price would normally take us toward. Be somewhere around this area, right? But how did I draw this line? This is essentially just signifying where our position is going to be held toward and where our area of interest is. Is this a line that I'm going to use as a God line where, I'm going to say like, oh, as soon as it hits it, I buy? No, I'm going to use it again as another range finding tool. Just connect your dots, right? So now you guys see how my lower time frame position got all its TPs hit, which their stop loss got hit, because I caught that retrace off of a lower time frame distribution schematic. Now, if you would have back tested that and you would have said, hey, well, is there more distribution above? Absolutely. You see this low get broken, and you end up coming back up here. And even if you miss that, that's completely fine, because it actually ended up coming back up to the order block, right? It ended up coming back up, which was perfect, right? But after this low was broken, that's when you could have also caught this position right up there, right? It all goes down to your own personal discretion, right? You could have also caught it right here as price mitigates itself. Price mitigates itself. You could have caught an entry right around there. You could have also let it go because you didn't like it. That's completely fine. Whatever fits your trading plan. And as I said, as a professional trader, you need to have a trading plan, right? Which means, what can you take if price is not as clean as you want it to be? Don't take it. There will be more setups. Don't be disparaging. You're not starving for pips. Okay? You should be devouring them, but you should not be killing yourself over them. Okay? So, meaning that if you have work, if you have other stuff to do, focus. If you have personal stuff to do, do it. The market's not going anywhere. Okay? So, I'm going to take a couple questions right after I stop the recording. Are you going to go over your trading plan, or did you miss it? I haven't actually gone over my personal trading plan yet. That's on day 4 or 5. That's on day 4 or 5. That's at the end. Once you guys have everything in, all the ammunition, then you're going to get your gun. Because, you know, if you don't know what the internal systems of or you don't know how to aim, you're not going to, you know, have a good weapon system. But that was a bad analogy. But anyway, does anyone have questions? And actually, I'm going to do the outro for YouTube really quickly, and then I will be right back for the questions and answers. Okay. So thank you guys so much for watching. This has been day 2 of the Wyckoff, of Hex's Bootcamp. I hope you guys enjoyed. I hope this shed a little bit more light on lower time frame entries and structure. This is something that I have been perfecting for the last year or so, and it's something that I have that I'm very, very proud to present to you guys as an IAM family. So thank you guys so much for being here. I hope this gets up to the higher ups, and if you are listening to me, Jason Brown, EP, everybody like that, I appreciate you. Thank you guys for inspiring me and putting me onto the platform, and I hope you guys have a great day. And everybody that's on the call, I will be right back with questions and answers. Thank you very much.